So, the big question is this: how are entrepreneurs and real estate investors like us, ones who want to grow our businesses and who are tired of paying for really expensive alternative lending, how do we tap into the most inexpensive money available and do it without the hassle of typical borrowing? That is the question, and this podcast will give you the answers. I'm Merrill Chandler, and welcome to the Are You Effable podcast. Welcome back. Merrill Chandler here, the host of Are You Effable? In this episode, we're going to be talking about how traditional loans and using the rules of the game are actually going to broadcast to lenders that you are a rockstar borrower. I mean, literally, you're going to tell them through the algorithm, through their underwriting systems, that you are a professional, kick-ass borrower. I'll be right back. Welcome back, everybody. Merrill Chandler here. And in this episode, we're actually going to finish our section on installment loans and how they tell lenders that you are a borrowing rock star, straight up borrower rock star. So let's take a look at what I mean by that. In this strategy, let's compare a traditional auto loan. So let's take a look at some parts of a traditional auto loan, and don't worry about the numbers. Just pay attention to how it contributes to your fundability and kind of what you're up against and how we're going to make this work. First, let's say the purchase price is $20,000. All right, fair enough. And we got our income tax back. We think we're awesome, and Aunt Mabel just gave us a disbursement in the family. So let's say we have $5,000 to put down as our down payment. Okay. Next, the loan value is $15,000. So 20 grand minus the down payment, our loan value is going to be $15,000, right? Then we make our first payment of $500, and our utilization is, of course, at 100%, because the utilization is the balance in relationship to the loan amount, or in revolving account cases, the limit. So our utilization is 100%, and our earned credit points is a big fat 0. And remember, they're not even going to start counting our points as we learned in the previous episode. They're not even going to start counting our points until month 6. So we get jack for having this loan. Now, I do put a caveat in there that if this is your first auto loan, as we discussed a few episodes ago, that the auto loan does trigger a, hey, I've got an auto loan component of FICO's scoring. Lender underwriting software does not weigh as heavily. The mortgage and the auto loan, they leave that to FICO. But FICO says, yep, you get points, 10 to 20 points just for having an auto loan. So we're not talking about those. We're talking about the value of the loan, not that it fills out a part of the mix category from FICO. Fair enough? I just want us to be clear there. Now, let's look at an optimized scenario. We'll take the optimized purchase price is the same. It's still $20,000, right? That $20,000, but this time we're not going to put any money down. We're not going to put anything down. We're going to say that this is we're doing 0 down payment. And something I'd like to throw out to you guys is that this is really important to understand. We've talked about the value of the Toyota Motor Credit, Ford Motor Credit, all of those different finance companies, and that they're tier 4 finance companies, but they're the ones who offer the 0% financing, because they're original equipment financiers, right? They're financing your equipment or their equipment that you're buying, right? That's what the car is. So in that case, but if you'll notice, there is usually never a 0 interest offered without there also being a rebate offered. And at current rates, that rebate is almost always a AAA paper, a grade A credit paper that is going to be the equivalent of what the money you would save on the interest for that term loan. So I never take the 0% financing from that lender, right? Because it's Toyota Motor Credit, Ford Motor Credit. That's a finance company. So I never take that financing. I take the rebate, which is the equivalent of the interest cost for that zero interest loan. Then I go get my own financing from a tier 1, tier 2 lender, as we always talk about in these podcasts. Now, going back, so we have a $20,000 limit or price point, no down payment. Now, the next thing we're going to do is that gives us a $20,000 loan value. Now, there's not a lot of difference here, but I'm trying to teach the principle. This loan is more valuable than this loan to the threshold markers of FICO and the lender underwriting. It's a more valuable loan. So right now we show over here improved score and improved underwriting. We get a big fat plus for having that higher loan value. Now, the next thing we do is instead of making a down payment, we take that Aunt Minnie's money, or Aunt Mabel, I think it was, and we take the tax return and we make the first payment. We don't use it as a down. We make the first payment using that same $5,000. Now, what that does is it improves our score and it improves our underwriting, because what happens is immediately on that first payment, utilization turns to, in this instance, turns to 75% instead of 100% from a traditional down payment auto loan model. That 75% is the message that you want to send to your current lender and to future lenders. What does it say to your current lender? It's saying, hey, I honor I treat your money with deference and respect. I want to make sure that you know that I'm serious about our financial relationship. I am going to lower the utilization so that if something were to happen, you even have more, you have more likelihood of getting your money back if for some reason I were to fail you in our relationship. That's what you tell your current lender, the lender who is carrying the paper on your car. What you tell future lenders is when they review your credit profile, when they pull your profile, there are markers, part of the FICO and or part of the lender underwriting software that's going to look for the ratio between payments and utilization, which means if you're making one payment per month, which is all you have to do, but if you're making one payment per month, then you get no bonus points and no penalties. You're literally just keeping your agreement. And if that's all you want, fine by me. But why I call this an advanced strategy is that in that first month, now it can happen on the first month, second month, third month. The point of this is to get ahead of the month, the payment modality in your monthly payments. Meaning, if I do this on my first payment, I'm going to have 75%. Every single payment I make thereafter, I'm ahead significantly of that amount. Now, you don't want to do too much in advance because you want the loan to last at least 24 months, because that's where, as we talked in the previous episode, that's where you get the most amount of juice, is keeping a loan open for 24 months. You also want to keep it above 50%. This number needs to stay above 50%. So using this strategy, you drop $5,000 as the first payment and then make your regular monthly payments so that by the end of 24 months, you're above 50% in the balance, and you are able to refinance, renew, release, etc. Right? So we get better score points and we get better underwriting by using this model. Now, here's what's awesome. The earned credit score points, that $5,000, if the payment is $500 a month, that $5,000 literally represents 10 months worth of points. Remember, you don't even get credit until month 6. So now you get not only the credit for the month 6, where they say, yes, you've got dependable, where you have been dependable on for 6 months, and they're not taking those points away from you, but you also have 4 additional months that are ahead literally on the first payment, guys. This is groundbreaking. When you know the rules, you can win this game. So the second you know what they're looking for, the second you know what a lender is looking for, you can play strategically to reinforce them and make a killing on points, fundability, and your value to that lender. Remember, they will put you in the game and give you the ball if you score every single time you get the ball. Here, you're scoring, your stats go up, but you're making them so proud to have you on their team. This is one of the most amazing strategies, and it works for every single installment loan, guys. Your fundability screams through the roof. It sends an amazing message to your current lender as well as future lenders, and it works on installment loans. So I'll tell you, somebody asked me at a boot camp, hey, does this work on mortgages, home loans? And I have a client. This was a couple of years ago, and he said he was going to pick up another property and he was going to put 30% down. And I said, hey, I have an idea. Just check this out. What if you're to put 20% down, so you get rid of the PMI and all the insurance and hit all the underwriting guidelines, so you have the best loan possible? But what if you were to take that last 10% and make it as your first payment? Would the number still work for you? Now, here's something I'm going to tell you, and I vet my lenders accordingly. We may have an episode about this. It's not very long concept, so it's not going to take up the 10, 15, or 30 minutes. But there's what's called re-amortizing your loan. And if you go make a loan payment, let's say here, and this loan payment is, some people say, yeah, but I'm actually making a larger payment because it's a $20,000 instead of a $15,000 loan. And what I teach my clients, and what I'm going to recommend to you, is that you find and work with only those banks who will take that first payment of $5,000 and then re-amortize the loan, so you can get credit as though it were put as your down payment. If you re-amortize that loan, they will lower the payments, and yet you get to keep the utilization. Now you have to find those lenders and work with those lenders. So amazing opportunities when you know the rules of the game, guys. So this was quick. So important. I wanted to focus an entire episode on it, because without this information, you can do this with mortgages, as I shared with you, with auto loans. You can do this with your Winnebagos and your any kind of recreational vehicle, your student loans, personal loans, grand piano loans, whatever loan you get, you can use this strategy, and it'll just kick its ass. Fundability goes through the roof, and the message you send to lenders, especially if you do this multiple times, imagine your entire installment loan portfolio, all the 4 to 5 that are open are all ahead of the payment schedule. Your utilization is more than the payment schedule would be calculated on an even monthly basis. You look like a credit funding god or goddess. So I'll leave you with that. It is awesome to spend this time with you guys. I absolutely love it. And I want to make sure that you become as effable as possible. This is what happens when you are effable. So have a spectacular rest of your day. You be well. Hey guys, thank you for listening to Are You Effable? Please leave comments, because I would love to read about your aha moments from this episode. And be sure to visit fundinghackers.com to view the blog post, get important links, join our community, and much, much more. And you gotta tell your friends about this podcast. We want them to become effable too.